Can you just tell me go when it's on? Okay, I think it's on.
It is.
Hi everyone, bonjour tout le monde. So today we're gonna speak in English. We're gonna listen in English. We might ask questions in English. This is a presentation about corporate class, corporate structure, and we are really thankful to have Peter Bowen, who is going to be our guest, our main guest today. Thank you, Peter, for coming and giving us your time. We also have Ghislain with us. You all know Ghislain. He works at Fidelity, and he's a great partner of us. So thank you all for being here. And Ghislain, up to you.
Well, hello everyone, and thanks for joining us on this session. And I'm going to say a few words for Peter. I've known Peter for 20 years, and if we have a healthy capital structure that offers sustainable tax benefits to our investors, whether it's individual or corporate, it's in big part due to Peter Bowen, because he's been at the forefront of the structure and especially took many good decisions throughout the years to keep it healthy. And that's why we're very proud of our capital structure, its offering, and everything it can do for his investors. Now, it's not just a capital structure we're going to talk about. We're also going to talk about a second tax smart solution, which is tax smart cash flow. But that's a secondary subject because we want to focus more on the applications of our tax smart solutions for holding companies and entrepreneurs. So on that, I'm going to pass it on to Peter Bowen, which is our Vice President of Tax and Retirement Research. And I think he's been at Fidelity longer than I have. Yeah, you have. You're a mid-90s guy, I think.
26 years.
26. Okay, you got 5 years on me. So Peter's going to go through a series of slides. We invite you to tap in your questions. So there's a Q&A button. Put your questions in there, and at the end, we'll treat those questions. If it lasts 30 minutes or 40 minutes, it's 40 minutes. We have a maximum of up to an hour. It really depends on your questions. So I'll pass it to Peter.
Excellent. Thank you, Ghislain. And thank you for having me on. Yes, we're going to talk about corporate class, which is a wrapper, call it, that is a tax efficient way to invest in investment funds and ultimately into stocks and bonds. So I am going to go through some slides. If someone can confirm we can see them on screen. Ghislain, are you able to see them? Excellent, great. So yes, we call these Fidelity Tax Smart Solutions, and that is the goal here. These strategies are meant to help individuals and holding companies, for instance, that have taxable money. That's where we get the benefits in this. So if it's non-taxable money like RSPs or TFSAs, that's not what we're focused on. We are focused on taxable money. So let me launch into the slides here and advance this. There we go. So as we go through this, let's think about the two goals that we have from a tax planning perspective. Firstly, we want to pay less tax, right? Obviously, that's appealing. Equally important, we want to pay taxes later. We want to defer taxes because we'd rather have the money in our account working for us than it be in CRA's account, right? And we want to control both situations. We want to control the tax treatment of the returns we earn and the timing of when they get triggered for tax purposes. Now, it's not entirely within our control. There are many other factors that play into this, but to the extent we can add control, we're going to be better off. Let's start in by talking about corporate class or capital structure. Those terms can be used interchangeably. So hopefully everyone is familiar with this strategy through your conversations with your financial advisor, but let me step back. Conventional investment funds are technically structured as trusts, and don't worry, I'm not going to get too technical on you. You invest in that, you get a share, an interest in that mutual fund or pooled fund, as the case might be, and that fund is invested in stocks or bonds or both, right? If it's a balanced fund, and you share in the income and the gains and the losses and the expenses and all of that fund with all of the other investors. Now, corporate class funds are very similar, but as the name suggests, the structure is somewhat different. They're within a corporation, right? And that brings different tax attributes to the table. So here we have a comparison of the tax attributes of conventionally structured funds in that middle column under trust, stocks, bonds, and ETFs, because directly held securities will also bring these attributes into play. And on the right, corporate class. Right? So let's focus on the top 4 lines. And you'll see under that trust column, we have check marks against interest income, foreign income, Canadian dividends, and capital gains. Well, interest and foreign income are both fully taxable. 100% of those amounts go onto your tax return. Canadian dividends are tax preferred in that we benefit from the gross up, so we actually have to include more on our return than we actually receive. But importantly, we get a tax credit, the dividend tax credit, that offsets some of the tax liability. So we end up with a lower tax rate typically on Canadian dividends than interest and foreign income. In fact, I think always. Finally, capital gains, right? Capital gains, again, are tax preferred in that only 50% of those go onto our tax return. So we've got four check marks against those lines. And what that means is if a conventional mutual fund or pooled fund earns those types of income, it will pay them out after expenses. So you get the benefit of the deductibility of expenses, but after expenses, and they'll show up on a T-slip, right? A tax slip that you will use for your federal and your Quebec tax return.
Peter, if I can add a little thing for the audience, what Peter explained is not just for mutual funds, but it's for most ETFs, or if you own stocks and bonds directly in a taxable accounts, you retain the tax nature of your investments, just like a trust fund. Yeah.
Absolutely correct. Yes. So let's switch over to the right-hand side in corporate class. Well, we do have a check mark against Canadian dividends, right? If you invest in an investment fund structured under this corporate class structure, you should expect to receive Canadian dividends. Typically pretty small, but you should expect to get them. We've also got a check mark against capital gains, right? But we do say potentially less than trust. Historically, that's absolutely been the case, right? And if people are interested at the end, I've actually got an example that demonstrates that over the last 5-6 years. Going forward, we expect this to continue to be the case, right? There are mechanisms we use to manage that. In any one year, though, that's not the case necessarily. So you need to be aware that you can get distributions of capital gains out of corporate class funds, and they could be significant in any particular year. Now, it's important to note that there are actually timing differences, because ultimately we all get taxed on the capital gains we achieve, unless we use one strategy that I'll cover near the end. Importantly, though, let's look at the top 2 lines. We do not have check marks. You will not see interest income nor foreign income show up on a tax slip. Right? Instead, as long as we're careful, it will be effectively earned as a capital gain, and sometimes even a deferred capital gain. Push that tax into the future. Now, obviously, that's appealing, right? Who wouldn't rather have something taxed as a capital gain rather than interest or foreign income? 50% inclusion rate versus full inclusion. Now, I've got to say that anytime you're pitched something on a tax, beneficial basis, you want to make sure you understand the tax risks. Well, this sounds pretty good, so you want to understand the tax risks. Importantly, this is actually the end result of the process. We're not doing any cute conversion of income into capital gains with derivatives or things like that CRA or Revenue Quebec would look askance at. No, this is the end result of the process. And there are constraints. So we have to be careful in how we structure and manage the overall corporate class structure, because otherwise we have certain implications that can start to degrade the benefits of corporate class. For instance, class funds themselves can start to pay income taxes. Now, our class funds at Fidelity have never had to pay any income taxes, and in the current year, we're not expecting to pay any income taxes. And we are doing our best to manage that corporate class structure to make sure that we either continue to pay no taxes, or if we do have to pay taxes, they're very small. Right? So puts you in a better position if you're able to earn interest and foreign income economically, but have it taxed as a capital gain. So for instance, you might look at a balanced fund that holds both stocks and bonds. Well, those bonds are going to earn interest income. Some of those stocks are going to be foreign stocks and earn foreign income, right? All those items are fully taxable, but again, you're not going to see them show up on a tax slip. Instead, that return that you're earning will effectively be taxed as a capital gain. So, I mentioned that I had a slide to show this in real life. We've got two portfolios. We've got one called Global Income Class Portfolio. So this is a class fund, right? It's within Fidelity's corporate class structure. And we are comparing it to a global income portfolio, the middle section there. This is one that's structured conventionally, structured as a trust. And you can see we are comparing the taxable distributions. That is the amounts that will show up on a tax slip and have to go onto your personal or corporate tax return. And you can compare them in all of these years, and you can see that the class fund, the class version, has significantly lower taxable income being generated than the trust version. But if you look at the bottom, you can see that the returns are virtually identical through this period of time. Right? So
I'll add this, Peter, because for the audience, Guy and his team have used Global Income Class Portfolio for the taxable accounts to get the fixed income within the capital structure. So this is being used already. So the reason I'm happy you use the Global Income Class Portfolio as an example, because of all of our different products, this is probably one of the most conservative or high fixed income content. Therefore, the most beneficial of the structure in many ways. So some of you may actually own this already in the class version.
And it's actually one of my favorite funds too, Ghislain. So yeah, and I should step back and say Fidelity's corporate class structure has over 80 different class funds available, right? There are equity class funds, there are balanced class funds, but you can't actually buy a fixed income, a bond fund in our corporate class. If we allowed that in, it could cause those other issues that I was referring to. So here's the example of the benefits of using corporate class, in real life. And I've got to say, in 2021, this could all change, right? We could have more significant distributions from the class portfolio than the trust version. But long term, we expect this trend, i.e., that is the distributions, the amounts that you are subject to current taxation on from the class fund, we expect that to continue to be significantly lower than if it was conventionally structured. Now, let's talk about, because I understand there are a number of business owners on the call. So firstly, let me step back and say, mostly I was framing that in the context of an individual, and an individual who has taxable money. And also tends to be in at least a mid-tax bracket or higher. Let's say income above 80,000 generally. It can work with lower income levels, but the higher your marginal tax rate, that is the tax rate that applies to the next dollar you earn, the more beneficial corporate class. Now, there are some business owners on the line today. If you have a small business and you have operating income, that operating income can be subject to a very low tax rate, right? Just over 12% in Quebec in 2021. That's obviously very attractive. Now, you always need to think about both what's going on within the corporation, your own corporation, the operating company or professional corporation if you're a medical practitioner, or holding company if you've moved investment assets there. You always need to remember to think about what's happening within the corporation that you own and what happens when you take the money out to the shareholder level. So if you have that operating income taxed at a very low rate, but you take it out to the personal level, it's typically taxed as a dividend, and not like a dividend from Canadian public companies, but at a somewhat higher tax rate. So let's say we earn an extra $100,000 in our operating company that we do not need currently for spending purposes, for our personal spending, and we can leave it in the corporation. Well, we've only paid $12,000 of tax on that, a touch more, but $12,000 of tax. That means we've got $88,000 left to invest. What's happening here is a very large tax deferral, and we're going to take advantage of it. Now, you may remember about 3-4 years ago, the federal government decided to make some tax changes because it didn't like some of the benefits that small business owners were getting. One of the changes they made was they said, hey, if you make more than $50,000 of investment income, we're going to start to take away your ability to get that low tax rate on your operating income. Not the end of the world, but we do want to pay attention to it. I'm going to set that aside. Let's look at Will and Susan, who have a corporation that over the years has built up $2 million of cash. Right? Pretty good amount. And we're going to look at a balanced income portfolio. Could be that global income class that I was referring to on the previous slide. There are other options available as well. Our mix of assets is going to be 60% fixed income. That is 60% bonds, so interest generating investments, and 40% equity investments, stocks. And some of those, of course, will be generating foreign income. Now, the corporate class funds, investment funds in general, have expenses, so we'll assume the expenses offset the interest income. The foreign income. Let's take a look at what happens here. Let's assume on our portfolio we make $43,000 of interest income. Okay. Well, under option 1, right, whether it's directly held securities, investments, stocks and bonds, or through a conventionally structured investment fund, we have that $43,000, it's fully taxable. Now, remember, this is within your corporation. And within the corporation in Quebec, investment income, interest and foreign income, is subject to a tax rate of 50.2%. You'll notice I've used some slightly rounded numbers on these just to illustrate the process. So our interest attracts $21,500 of taxes at the corporate level. Okay? But if we pay a dividend out to the shareholder, we get some of that tax back, and we could pay out a $34,000 dividend. Let's look over at option 2. Right? Option 2 is in the corporate class structure. So instead of having fully taxable interest income, we have it effectively taxed as a capital gain, 50% inclusion rate. So only $21,500 is actually taxable at that 50.2% rate. So you'll see our tax burden within the corporation is half as much. Our dividend is half as much. When we add back the non-taxable portion, the distribution to the shareholder, the dividends we pay out are a little bit more, $38,000 instead of $34,000. But remember, this is only half the story. We now have to look at your personal level, shareholder level. How are these taxed? Well, on the left-hand side, you can see that it goes out as a dividend. It's subject to a fairly high tax rate. Right? If you're in the top tax bracket in Quebec, it's a tax rate of about 48%. Now I'm using national averages here, so it's 47%, so pretty close. If it went out as a regular dividend from a public company, if you were able to earn a dividend from a public company, just so you understand the difference, it would be at about 40%. But no, we're at 47%. Now, that's $16,000 of tax. That means after taxes, we have $18,000 of income from our initial $43,000 of interest income. Okay, let's look at the right-hand side. Right here, it's coming out of the corporation again, but remember it was earned as a capital gain. So we've got $38,000 to distribute. But here's the key. Half of that initial capital gain, right? Remember 43,000? Half of that, 21,500, can be paid out as a special dividend called a capital dividend. capital dividends go out to shareholders tax-free. No further tax. So we're going to split this $38,000 dividend, pay $21,500 as a capital dividend, no tax, and therefore the remaining amount, only $17,000, it's taxed again at this 47%. Okay? So we only have $8,000 of tax. When we add back that capital dividend, we are left with over $30,000 in our pocket at the end of the day. Now, you might not pay out these amounts from the operating or holding company or professional corporation for many years, but you always want to remember you have to factor that into your thinking. So at the end of the day, by using corporate class rather than conventional funds or indeed directly held securities, stocks and bonds, we've got more than $12,000 of additional money in our pocket. It's money that's in our pocket and not CRA's. Let me talk a little bit more about this so-called capital dividend just to show how it works. This is if it was on a $100 capital gain. Well, we split that $100 capital gain. 50% of it is taxable within the private corporation. Right? And remember, in Quebec, we're taxed at 50.2%. That's my corporate tax burden of $25. We get some tax back if we pay a dividend, so we're able to pay $40 out as a taxable dividend. It's called non-eligible. It's just the tax terminology we use, but it attracts $18 of tax. The other $50, remember the non-taxable portion. In my previous example, it was $21,500. In this example, it's $50. It's in what's called the capital dividend account. It's paid out tax-free. Add our numbers back, and we've got $72 after tax, having earned something as a capital gain rather than interest income, where it would be something more like $45, $46. So that's the benefit of utilizing the corporate class structure within an operating company or a holding company or a professional corporation, is that we're able to have more cash in our account at the end of the day.
And if I can add, Peter, this tax efficiency also allows you the choice to invest in a diversified manner, meaning that if you want it to be more tax efficient without capital structure, well, you'd kind of want to avoid anything that creates an interest, and that's not really always appropriate for more conservative investors. You also might want to avoid foreign diversification or dividend-paying stocks, excuse me, outside Canada, but maybe from an investment standpoint, you want to be exposed to dividend-paying stocks outside Canada. So capital structure provides you that tax efficiency while remaining flexible with your investment decisions, because within the capital structure, Guy and his team can choose a host of different investment vehicles independently if you're aggressive, conservative, and your geographical diversification.
Absolutely, yep. So that's corporate class. It benefits both, moderate to high tax bracket individuals that have taxable money. It also benefits private corporations that have built up investments. Let's switch gears now and think about getting cash flow in retirement. So you invest, let's say, $500,000 over the years with your financial advisory team here, and it's grown to $1 million, and you retire. Well, now you need cash flow. So how do you get it? Well, historically, you would start to sell some of those investments each and every month. The challenge is that will trigger a capital gain each and every month. So we have to pay taxes. There's a better way to do it, right? Tax smart cash flow, or if it's bolted onto a corporate class structure, which is at the end of the day pretty much ideal, we can refer to that as TClass. And it's an automatic program designed to distribute cash flow out of the same investment fund that you built up that gain. So we're just turning on a faucet to give you cash flow, and it is tax efficient. Explain why in a second. But notwithstanding our cruise ship and our private island underneath those 5% and 8% bubbles, But that's not a yield. It's not a rate of return. It is a rate of cash flow. Right? And it can be customized. This is a new feature that we've launched very recently to allow you to say, I want a set dollar amount to be distributed out of my investment. And as long as it's below 8% of the investment, you will be able to get that a very stable level of cash flow based on however much you want to get. How does it work? Well, these are national average top marginal tax rates. And you can see, those are similar to the rates I've talked about. The interest in foreign income on the top left, 52.5% is our national average, 53.3% in Quebec. But let's skip along to the right-hand side. Return of capital, taxed at a 0% tax rate. Pretty good. Now, why would that be? Why would they allow that? Well, think about that $500,000 that you put in. That was after-tax money. You'd already paid tax on that portion. What this solution allows us to do is to give you back that money over time, right? It's not immediate, but over time. And so that's why it's called a return of capital. We are returning your original capital. Well, you already paid tax on it. Why would you pay tax on it again? Right? So we're able to pay these amounts out. And at the end of the day, it's a tax deferral because the trade-off is that it reduces your cost basis, adjusted cost base. But that's a good trade-off in most circumstances. Tax deferrals are not always the right answer, but working with your financial advisory team, that's where you can figure out when it's right for you. If you happen to be in a very low taxable income year for some reason, like for instance, you just retired and you're not getting QPP or old age security yet, and you haven't converted your RSP into a RIF, well, maybe that's not the right time to take advantage of it. Depends on the circumstances, still could. But then you start those items, QPP, OAS, your RIF is paying out monies, and maybe you're subject to the old age security clawback once your income goes above $80,000, right? That's an ideal time to take advantage of this strategy. I mentioned that we've done some enhancements recently. We have, again, provided that ability to get stable cash flow, because when I talk about that 5% or 8%, right, that's of the market value of the investment. Market values will change over time. Sometimes they go down, more often they go up, and the amount that gets paid out gets adjusted from time to time. Sometimes people would prefer a consistent amount over a longer period of time. We now have the facility to allow you to receive that stable cash flow. And the redirected cash flow component, right? We now, previously, it's like when you turn on that faucet to 5% or 8%, or now the custom amount, for instance, the only option was to get it in cash. Now we will allow you to put that into a different investment fund. Right? Again, ideally, perhaps a corporate class fund. But let me give you an example. So I might have an investment in a global equity class fund that has done very, very well. And we've got some that have done terrific over the last few years. The problem is now you're probably overweight that particular investment. Well, if you want to shift to another investment, at least part of that into another investment, you're going to trigger the capital gain. Pay taxes again. Again, there's a better way to do this. We say, okay, we're going to turn on the cash flow, but we're going to redirect that into another investment fund, maybe a more conservative fund. Could be a bond fund, could be a balanced corporate class fund. And slowly over time, without triggering those capital gains taxes, we'll be able to shift our portfolio to be somewhat more conservative. So that's strategy number one. Strategy number two is a charitable gifting idea. So I've actually done this. Let me describe exactly what I've done. Several years ago, I made an investment, cost $10,000. It is now worth $20,000. So what I've done is I've turned on this feature to start getting 8% of that investment each year. Roughly, it's never exact. And what I'm doing is I'm saying, let's take that cash and let's purchase a different investment fund. Okay? A balanced income corporate class is what I'm using, in fact. So my global equity class will see these amounts go out, and it will reduce my cost base. My adjusted cost base will go down over the next few years. Now remember, it's 8% of my market value of the 20,000. So really it's about 16% of my adjusted cost base, which is 10,000. So it will take 5-6 years, for instance, to get all of my original capital out and move that over to a different investment, which will now have that cost base. So in 5-6 years, I may have an investment worth $15,000, $20,000, $25,000, who knows what it's going to be worth, with an adjusted cost base of 0. Now remember, I've deferred a capital gain. That's what we're doing here. Here's what I'm going to do. Each year, I'm going to start donating some of that to charity. Let's say I want to donate $3,000 a year. Well, I'm going to take $3,000 of that particular investment. I'm going to donate it directly to a charity. And charities are set up to do this because there's a tax benefit. A number of years ago, the federal government brought in some tax rules to encourage charitable gifting. And what they said was, if you donate investments in kind, and by that I mean you actually give the investment itself, so you don't sell it, you give the investment itself to the charity. You get the charitable donation receipt for the market value of what you donate. And you do not have to pay the capital gains tax. So I donate $3,000 to a charity. I get my charitable donation receipt for $3,000. I technically report my $3,000 capital gain on my tax return, but with a 0 inclusion rate. This is the most tax efficient way to do charitable gifting. And I've actually done this mechanism in terms of seeing how it's done because I had to act as executor to my mother-in-law's estate. She passed away 4 years ago now, and she had a modest donation to a hospital, Saint Justine, I believe it is, the Children's Hospital in Montreal. And what we did was that we donated an investment that we had this cash flow.
Appreciate that, by the way.
Yeah, well, my wife grew up in Montreal, so donated it directly to the charity. A little bit of paperwork, but easy to do. And on my mother-in-law's final return, we got the charitable donation that we could take advantage of on that final tax return. And again, didn't have to pay the tax on that capital gain. So, seen it in action. The paperwork's pretty easy, and it's again the most tax-efficient way to do charitable gifting. This shows with larger numbers than my mother-in-law or than I'm able to do, but just demonstrates this. And we actually have a brochure available in both English and French that describes exactly how this works. So that's the end of the formal part of the presentation. I am happy to take questions if there are any from the audience. Ghislain, or if our financial advisory team have any questions, I'd be happy to address them.
Thank you so much, Peter. It was so interesting. I never seen this so in such detail for the charitable gifting. It's very pertinent. Miriam, do we have question in the feed?
I don't see any.
Not in the chat,
Mm-hmm.
but we do prepare some.
Yes. Do you want to ask the first one, or should I go?
You can go.
Okay. So one question we had, the whole team, Peter, for you, was: is it possible in a way that the government would stop allowing the corporate structure to be used by the financial industry, the brokers, and all?
That's a great question. And I think anytime something's being pitched as tax advantaged, and let's be honest, these are being pitched as tax advantaged, we have to be aware of the tax risks, which are twofold. One is that CRA or Revenue Quebec comes along and says they disagree with how it's been taxed, treated for tax purposes, and they reassess us. Okay, that's bad news. On both these solutions, though, CRA and Revenue Quebec are very familiar with them. we're not doing anything aggressive from a tax perspective. So I think we're in very good shape there. There are more aggressive strategies that some of our competitors use, and are in the more broader tax planning world that you need to be a lot more careful with. But the second risk is, to your question, the risk that CRA, the federal government, changes the rules on us and makes this ineffective. Well, that's always a risk we can't control. It could happen down the road. If it does, by the way, there's a tax efficient way to unwind the whole strategy and continue to have investments. But again, CRA is very familiar with this structure and yet has left it in place. They have gone after things that you would think of as a so-called loophole, right? And made tax changes, but they haven't touched corporate class. They haven't touched tax smart solutions. By the way, both of those are available not just from Fidelity Investments, but from many other investment fund managers in the industry. So there's a lot of these available. They've existed for a long time, and CRA is very knowledgeable about them. So I think the risk on that side, never say never, of course.
Yeah.
But if they wanted to shut it down, they could have done so by now.
Okay. Thank you. I have another question. It's more like a personal question, because we work with the accountants of our clients, and we notice that they, like, some of them don't know the structure. I don't know if is it something that's not being taught in their field, or
It's a very good question. I still get that as well.
Okay.
And the answer is it does not get taught. I didn't learn about it when I was in, well, actually, I was in university before these existed, so it's not really fair, but it wouldn't be taught now because accountants, firstly, when you're taking income tax courses in university or beyond, right? There's something called the in-depth tax course that people go to. There is a huge volume of material. The Income Tax Act itself is something like 3 inches thick of tissue-thin paper. So there's a lot there. And corporate class and tax smart solutions are like a little niche area. So in fairness, it's not taught at that level. And therefore, accountants often have not heard of these. So that's one of the things I do, is I have meetings with accountants to walk through the exact mechanics of how this works. What are the tax act sections that we're relying on to inform accountants, to educate accountants. But it's a great question, because no, they're not. And remember, accountants tend to specialize, right? The accountants for a lot of the people on our call today, some of them will focus on high net worth individuals. Some of them will focus on small businesses, right? Or maybe it's the mix of those. There are other accountants that specialize in banks, right? So corporate class and tax smart solutions are very, very narrow areas of the Tax Act. And I think that's why accountants typically are not familiar with them. So we've got brochures on this to try and educate people about how it works. And Ghislaine and I have often done meetings with accountants to talk about the mechanics of how it actually works.
Okay, thank you so much. Miriam, do you have questions? Ghislaine, maybe a comment?
Nope, that's
All right.
I'm good.
Miriam, I haven't heard.
No.
Okay. 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 So yeah, thank you all for being here today. And I think the link of the video will be available on the website maybe in a few days. And in the meantime, if you have questions, we can still plan a call with Ghislaine and Peter, maybe to talk more in details of it. At the end of the month, if I remember well, it's the 27, I think. Ghislaine will 28. Oh, sorry, 28. We'll have Ghislaine for another webinar, and we'll discuss corporate class and other subjects. But we can wait for the next presentation. So thank you, Ghislaine. Thank you, Peter. And
Welcome. My pleasure.
Thank you. Bye-bye.
Thank you, Peter. Thank you, everyone. Bye.
All right. I think it's ended. Thank you a lot, Peter. It was very interesting.
Excellent. Well, my
Yes.
pleasure. So if you
And-
have any follow-up questions, by
Yes.
all means, let me know.
I have another one, a quick one.
Yep.
Imagine that I wanna put a lot of, not maybe a lot, but some accountants together. And is it possible, you think, to give them like